Hello everyone, this is Sebastian McMahon from IA Financial Group and I'm back with the weekly review for the week ending June 2nd, 2023. So let's start with a look at this week's markets. At the close on Thursday, so positive for bonds, negative for stocks. So movement this week based on the expectations around the debt ceiling, also the resolution of the debt ceiling saga. We also had some downbeat data in the US coming from the ISM Manufacturing Index earlier this week. Now, as I'm recording this Friday morning prior to market open, very strong jobs creation in the US. So a volatile backdrop, lots of stories happening at once. So it's going to be an interesting few months ahead of us again. Positive for bonds year to date. We're still at about 5% for the long index, which is good returns. The balanced portfolio is back in 2023. Very good news. The stock market negative in Canada, EFI and emerging markets. Positive in the US, but the US dollar was lower this week, meaning that if you bring everything back in Canadian dollars, pretty much negative everywhere. The star of the year so far, of course, is the Nasdaq. More on that in a few minutes because of technology. That's returning about 30% this year. But we have a very fragmented market right now, very narrow breadth, and we still remain with some caution, let's say, in our positioning in the US. Oil lower on the week on the prospects for softer global growth. Chinese PMIs were lower. Canadian dollar higher, euro higher, and the price of gold also higher. So maybe the first thing to look at, the debt ceiling. We do have a deal. Americans love politics, and that was lots of uncertainty for not too much at the end, as it is the case most often. Now it still remains the question: will we see some downgrades because the U.S. politicians are willing to use a potential default of payment as a political tool? Credit agencies don't tend to like that. And remember that in 2011, when we did have the downgrade from S&P, it was after the deal was signed, not before. So let's see what happened this time. But on the right, a few details of what happened. So the debt ceiling is suspended until 2025. We got the vote in the Senate on Thursday night, so it's a done deal. Caps on spending, but not on defense. Unspent COVID funds need to be returned. Welfare is largely unchanged. Some measures of labor market support have been affected by that, very specific things, but largely unchanged. The pause to student loan relief is about to be over at the end of the summer. Mr. Biden wanted to write off that debt. They agreed at some point earlier to put a pause on the repayments. Now this pause will end. That should draw a hole in many households' pockets for H2 of this year, which could be an economic headwind. Let's see. No new taxes and no change to the Inflation Reduction Act, which is very important because the energy transition investments will be massive in the US. Lots of subsidies, lots of investment. Strong reaction by the federal government in Canada, provincial governments, to make sure that we get our piece of the pie of the energy transition investments. So no change to that, which is supportive of future economic activity and maybe of markets. Now, other signals, well, the US labor market remains tight. So this morning we had the jobs report for May in the US. Over 300,000 jobs created, way above expectations, and the month of April was revised higher. So we still have a pretty tight labor market. On the right, though, you see that the quits rate, so this is the percentage of people that are leaving their job, but they don't have any other job lined up. They are willing to take a bet that they'll find something else. Well, this tends to be a very useful economic indicator because when the quit rate is high, typically that means that you have a very buoyant economy and wage growth remains strong. And when the quit rate starts to fall, just like right now, usually that correlates well with falling wage pressures. So labor market is tight now, but if you look at some leading indicators, maybe down the road, wage pressures could subside and we could have less inflationary pressures, maybe helping the Fed. Which brings us to the Fed now pausing in June. Big question mark. Two things on the left. You have the choir of the Fed, some officials under the just talk to journalists unofficially and preparing the market for skipping a June rate hike. Maybe hike later. This is still in the plans. Some officials have been more vocal, like Mrs. Loretta Mester, bottom left of your screen here, saying that there's no reason to pause, even going as far as saying that now that the debt ceiling issues are behind us, this is one less source of uncertainty, so let's hike again. So it's not clear where we will end up. We still think that the likely scenario is that we'll have a pause in June, maybe even in July, so a pause during the summer, looking at what the data have to tell us. But after that, if we continue to see sticky inflation, strong labor market, housing prices that rebounded to just like in Canada, maybe there are some more hikes by the end of the year. So which brings us to the chart on the right. There's still rate cuts that are priced in for late 2023, early 2024. We still think it's much too early to be pricing in rate cuts. More rate hikes are more likely in the future. So in Canada now, the strong growth in Q1, a 3.1% growth on GDP, seasonally adjusted annualized rate, so an annualized pace of 3.1%. The Bank of Canada was expecting 2.5%. Leading indicators are pointing towards about 0.9% in Q2, which would be a slowdown. So again, here for the Bank of Canada, the economy is strong. Housing prices have started to rebound. Inflation is sticky. Still, we think that the Bank of Canada should stay on the sidelines, maybe through the summer, and then reassess after the summer to see if there's a need to do some more, because it's still too early to tell if we've done too much or too little on the monetary policy side. So big question mark again here, but the recession that we were expecting in 2023, we're talking about significant odds. We were at some point at 70%. Now we're much lower, below 50% odds in Canada of a recession. Even I would go so far as saying 30 to 35% in Canada, maybe 50% in the US. The odds of a recession by the end of 2024. But maybe in H2 we could see that. It should be a shallow recession, not a deep recession. But H1 at least we can write it off. The start of the year is strong. Q2 should continue to carry some momentum. So maybe it's more of a late 2023 or early 2024 story here. Now maybe looking at markets, breaking down the recent returns. On the left you have the S&P 500, and on the right you have US rates. So let's start on the left here. Every stick is a quarter, so it's quarter to date for Q2, so April and May. June is just starting here, and we had some positive returns, slight positive returns in Q2 so far, mostly coming from a revision upwards of EPS, but it's mostly from the big 10, the big technology names like Nvidia, which just blew everyone's expectations on their expected earnings. This is where we have a story here. To go overweight the US stock market, you need to be very optimistic on EPS growth, despite all of the leading economic indicators that we have that are showing that sales growth and EPS growth should be under pressure. You need to be willing to pay 18.5 times expected earnings in an environment where interest rates are high. So, it's not because it's expensive that it can get more expensive, but we would say that there's much better opportunities elsewhere to invest in the stock market. Stock picking is very important, though. We'll discuss that on the next slide. But on the right, interest rates, just to show that it's the real rates that pushed higher. So it's not because inflation expectations move so much, it's just the real rates moved, and typically higher real rates means pressure for gold, explaining why gold has been under pressure, and we remain gun shy about putting some gold as a diversifier now in our portfolios, but maybe more to come in the next few weeks or months. Why active management matters, to conclude here. So on the left, you have a quilt chart of the returns of the sectors over the last few years and year to date. As you can see, information technology, communication services, and consumer discretionary are leading the way and have posted very strong returns, 30%, 20% year to date after 5 months. So very strong. But all of the other sectors are down this year. So leadership is very thin. So it's the big tech, it's Amazon, so it's these companies that are leading the way. And on the right, what you see is that if you take away the AI-linked names, then the S&P 500 would be down this year. So it's really about very narrow leadership, AI, tech. Only about 44% of the S&P 500 names trade above the 200-day moving average. And when you look at historical charts, you see a very narrow market, and usually these are fragile markets. So we don't know when the AI boom will end, or if it will end, how far it will go. But we'll say that it's important to be in the right names. On the asset allocation side, we'll look at the U.S. stock market we see the U.S. market as being expensive, so we tend to favor other markets. But stock picking here is very important, and we rely on the underlying stock pickers in our funds to add some value in the US because of the fragmentation of the market. So what to watch next week? Building permits in Canada, Bank of Canada rate decision. We don't expect another hike. We expect them to stay put. The jobs report in Canada, and in the US we'll have the ISM services index and durable goods orders. So it's always a pleasure to serve you, and I'll see you again next week.